So I came across this interesting article from Money Sense. This guy from British Columbia, who's got 170,000 in his TFSA. So obviously the max that he could contribute to his TFSA is 57,000. So that means he practically tripled his contribution. And apparently the way he did it is by buying a few good stocks and holding them forever. But obviously if the timing is good, then that strategy works. You can't just buy any stocks and just expect them to grow this fast just because you're holding them forever. So let's look at his story. So these are the stocks that he holds. He doesn't hold much. He's got 5 stocks. Only 1% of his portfolio is cash. Everything else is stocks. He's got 54% of his portfolio in Visa. So for sure, Visa is definitely one of those great stocks, Visa and MasterCard. In fact, I was looking at them yesterday. They're just like a straight arrow. Here, let me bring up the chart here. If you look at 1 year, look at this. It's just a straight arrow. When do you buy in? 5 years. Look at this. So obviously, if he bought it back in 2009 or 2010, definitely a great purchase. It never goes down. It never gives you an opportunity to buy in. 52-week low is 102. 52-week high is 150. It's at the 52-week high, and the 1 year target is 160. Yahoo Finance gives it a 1.7 rating, so basically a good buy. So last year, 18 billion in revenue and 6 billion in profit. Pretty good returns. Always beating their estimates, as you can see here. And MasterCard, same thing, just a straight arrow. If you look at 1 year, another straight arrow. They're basically moving the same way. 52-week low for MasterCard was 137. Damn. And 52-week high is 223. So that's just this past year. This past year, it went up 62% just in the past year. They both pay very little dividends, though, under 1%. But in terms of capital growth or capital gain, it's definitely there. So these are payment processors that are not going to disappear. There are some competitors, obviously, but MasterCard and Visa are never going to disappear. They're too big. They own too much of the market share. They're taking care of their customers. So really, there is no reason for competitor threat. And remember, they're not the banks. They're not the ones lending the money. They're just the payment processor. So they're the third party. Notice with a MasterCard or Visa, there's always a bank attached to it, either MBNA or CIBC or TD. But with Amex, there's no bank attached to it because Amex is the lender. Amex is the bank and the payment processor. Even Amex is a great stock, but it doesn't go up in an arrow though. Sometimes it gives you opportunities to buy in. If we look at 1 year, so you could have probably bought it here at 92. When everything dropped back in February, was a good time to buy Amex. Right now it's at 110. 2-week low was 87. 52-week high was 111. It pays 1% dividends. And it's a stock on Warren Buffett's portfolio, so that's good. I think MasterCard and Visa are definitely on his portfolio as well. So let's see what this guy did. So he opened the TFSA in 2009 and made an annual contribution since then. So basically, he says his strategy not very popular with financial advisors, but what he does is he holds a few stocks and just holds them long term. Although some might say that it's best to diversify, he feels if you diversify, you lower the return on your investment, which makes sense because every trade you make, so let's say you're trading with 100,000, and every time you make a trade, you only trade with $1,000. Well, then how many trades do you have to make so that your whole portfolio of 100,000 grows? But if you make one trade that's successful, well, then your whole portfolio just increased by that much gain. It's risky, but that's his style. So he's got only 4 or 5 stocks. And also they bought when the US and the Canadian were at par, when the US was trading at like $1 Canadian. So that helps him out because already just with the exchange, he's at a 30% gain right now. So the first stock he bought was Visa, and then he bought British Petroleum. So his main strategy is to buy and hold. Apparently he hasn't sold a single stock since the inception of the TFSA. His reasoning is passive investing will outright beat active investing. So his thinking is, if you know the company is going to be around for a long time, then why sell? When you sell for a gain, which is what I talk about, you've created a problem, which is, what do you do with the cash? You let it sit while you watch the same stock go up in price and then feel you shouldn't have sold, so you try to buy it back again but at a much higher price. See, I don't do that. Once you sell, you look for another opportunity, and it doesn't always continue to go up. Sometimes it goes back down, which creates another opportunity to buy. But yeah, I feel like he picked the right stocks that he can buy and hold long term. I mean, Visa, as you can see, it's just an arrow going up. It says he only buys on a market correction. So look to when the price has been beaten down and get ready to buy more when the price goes lower. He says he doesn't look in companies' financial statements. He says they provide very little information, and basically it just tells the investor what the company wants the investor to know. So it's window dressing. I think that's a good point, actually. So to summarize, his strategy is buy when markets are in chaos and hold when markets are doing well forever if you can. So that's a great strategy, but the only thing I'd question is, how do you confirm your profits? When do you get to benefit from your profits? And not all the stocks you buy are going to go up in an arrow. Some of them are going to come back down to the same price you bought it at. So that temporary capital gain that occurred, you did not benefit you. You never took advantage of it. So it's like wasted profits, in my opinion. So I thought it was an interesting article to share with you guys. It's good to see it. I guess it's inspiring to see someone reach that high of an amount in their TFSA. So it's proof that it's doable, and it goes to show that it's important to buy at the right time and to start early, because you miss out on good prices sometimes. And I guess holding long term is not a bad strategy. I mean, there is no bad strategy. There's probably better strategies, but as long as you're making profit, they're all good strategies. And it also depends on your goals, right? If you need the money right now, or if you just want to grow your portfolio, if you just want to increase your wealth, versus if you want to generate revenue. But at the end of the day, buying stocks low and just keeping them or selling them when they go up seems to be the right strategy. It's to focus on big name players. Just wait till they fall for whatever reason, buy them, and just hold on. Some people hold on forever. Some people hold on until they make a decent profit and sell, and then just repeat the process. All right, so here's a stock that I regret not seeing earlier, like a few days earlier. Honda Motor. Great stock, of course. 52-week range is 20 from 28 to 37. Right now it's trading at 30, so close to the 52-week low. It's got a market cap of 55 billion. Pays dividends of 3%. So as you can see in the chart here, it's close to the 52-week low. It hasn't been trading above 30 that long though. Well, you could say it's been trading above 30 for maybe like 3-4 years. But what I like about this stock, obviously the name, Honda is never going to disappear. It makes a great product. Just gets better and better every year. But look at the financials on this. So this is not 15 billion. This is 15 trillion. 15 trillion in revenue. This is very sad. And then net income is 1 trillion. So last year they made, not even last year, this is quarterly, this is annually. So yeah, last fiscal year they made 1 trillion profit. The year before that they made 600 billion profit. 600 billion profit. While Facebook makes like 15 or 25 billion profit, Honda makes 616 billion profit. The year before that, 344 billion. So you can see their profit is growing. So it doesn't make sense that their stock price is down. So it's definitely a great buy. Let's see what Yahoo Finance gives it. So it gives it a buy recommendation, as you can see here. Let's see the analyst let's see some reports in Investor's Edge. So you can definitely trust a company that makes $1 trillion profit. I definitely think this is undervalued. I don't understand why the stock is not higher. So if we let's look at reports. So CFRA, I'm sure it's going to be a strong buy. So I'm seeing this for the first time. Just a buy recommendation, weak. Should be a strong buy, and a 34 12-month target price. Perfect. Let's look at Morningstar. gives it a fair value of also 34. So the upside is not great, probably like 12% if you buy it at 30, but it's definitely a stock you can trust. In fact, I put an order on it in my RSP today. I put an order at 29, 79 shares at $29. I hope it drops a bit. If not, I'll have to buy it at 30 because I don't want to miss out on this stock. That's why I say I'm disappointed that I didn't see it earlier. Because I think if you look at 5 days, yeah, 5 days ago it was trading at 29. Very disappointing. 1 year target price according to Yahoo Finance is 35.75, and it pays 3% dividends while you're waiting. So it's not bad. It's really, well, I put an order on it, so obviously you can tell that I like it. Let's just look at the revenue again. It's just too funny. Yeah, 15 trillion. Wow, 15 trillion in revenue. And a trillion in profit. Unbelievable. So now, if I've learned anything from Brendon Lee's strategy, it's probably not to diversify too much, which is something I was doing. I'd always buy in $1,000 chunks, but then whenever I sell, whenever I make 10%, it's only $100. Minus the fees, it becomes $90. So I'm gonna try to put bigger amounts per trade, as long as I'm trading with big name companies that I'm confident in. It shouldn't matter, but at least when I sell at 10%, then it affects my portfolio as a whole. It has a bigger effect on my portfolio, and I don't have to look for as many opportunities. Instead of looking for 20 or 30 opportunities in the year, I'll just have to look for 10 or 15 max. So that's something I can take from this article, is maybe not diversify too much, as long as you're buying good stocks, but don't necessarily agree by holding long term. And I'm going to do a video on that for sure, explaining why I would not hold long term, or what do I prefer and why I prefer it. Buying and holding long term, or buying and selling short term and just repeating the process. GM right now is also a good one, because I know it reached 33 last week. I'd probably buy it at around 34. If it reaches 34, probably buy it. That's if Honda doesn't reach 29 first. I'd prefer to buy Honda, but GM would also be an excellent buy for me. Alright, so just wanted to share with you this article that I came across, found it inspiring. It's nice to know that it is possible from a TFSA. So all this is tax-free. So if he decides to withdraw anything from it, it's tax-free. Or any future gains he makes from it is also tax-free. But it looks like he just wants to hold it long term. He just wants to grow his portfolio without necessarily using it. So it also, obviously it depends on your strategy, and it depends also when do you want to benefit from your portfolio. So if he's giving himself like 30 years, then he's very confident that in 30 years, whatever he does, his portfolio is going to grow. And look, as you can see here, he's only got like 5 stocks: Visa, Crescent Point Energy, British Petroleum, I don't know what this is, ADR, American Department Receipts probably, and Sienna Senior Living. Alright, if you have any questions, any comments, leave them in the comments below. If you're going to open an account with Questrade, use my referral code in the description below the video, so you can get between $25 and $250 depending on your initial deposit. Thanks for watching.